Well, hey everybody, it is Friday, and I just wanted to give you a little bit of something to think about over the weekend. What I don't want this to be deemed as advice, or I'm telling you that you should or shouldn't do this, but with regards with what's going on with the coronavirus or COVID-19, I wanted to share with you some of my thoughts, and you can take them and digest them as you will and see how it could play out for you and what you think is best for yourself to do with either this additional information that you receive or just digesting it and interpreting it for yourself. I wanted to explain I've been tracking the COVID quite carefully. I've also been getting quite heavily involved in the stock market, so it has given me a pretty big understanding of a few things that I think are pretty important. So here we go. Coronavirus stats, just so you guys are aware, they did show a little bit of a leveling off not too long ago. It was probably about 5 or 6 days ago. We saw a fairly substantial leveling off of coronavirus cases both here and in the United States. Now, that was somewhat to be expected because I think everybody was doing a good job by social isolating and doing what they needed to do in order to draw down the amount of contact that people were having. So that was great. Squamish has been particularly fortunate in that we, knock on wood, have not had a case in the Squamish hospital yet, which has been a blessing, I gather. So that's good. But the COVID number of cases has actually been going up just marginally in both Canada and the United States over the past few days. And I started to wonder whether or not that's because people are just getting a little fed up with the social isolating and they've decided to try to go back to work. And then ironically enough, the United States announces that they're going to try to get some of the states to sort of gradually get back to work. And now Canada announced today, Justin Trudeau indicated that he wanted Canada to start easing back into the work situation. Now, it's great for the economy. It is needed. And without putting in my personal opinion as far as how serious the COVID thing is, I think it's just something that we need to be aware of, that likelihood is that we're not quite ready for that. I would think that you're going to see some more cases come on, and it's not going to be sort of we start going back to work and no extra cases come up. So hopefully they can manage that. Hopefully the hospitals can deal with it. But that's where we're at as far as the corona cases go. So I wanted to talk to you about a few things in regard to bank rate. So when the coronavirus hit, when it started, all of a sudden the Bank of Canada came out and they cut the bank rate down. Now the bank rate is the rate that banks can loan to each other to cover their short positions, which is what they will do if they've over leveraged and they close out and they can't. So the overnight lending rate or the bank rate is what they use to lend to one another. It is not what you get paid, or what you have to pay if you have a mortgage. Now, a couple of times the Bank of Canada reduced that rate, the bank rate, but mortgages went up. And in some other cases, mortgages went down. So it really depends upon the bank. They still have to make a profit. So their profit is on mortgages is based on the difference between the bank rate and the mortgage rate that they charge. That's how the bank makes money. So keeping that in mind, the Bank of Canada has made it clear that they do not intend on lowering rates at all anymore. They are done at a 0.25. They don't feel as though there's any benefit going to negative interest rates. So we're unlikely to see anything. And I suspect that the only way they'll go to negative interest rates is if there is a substantial uptick in the cases and they need to do something to try to stimulate the economy. But at this point, the Bank of Canada said they're not going to go any lower. So that being said, we need to look at the mortgages and what's going on with mortgage rates. So what's interesting is that although they've covered a lot of things in the way Canada's dealing with it, what they haven't covered is when people go to apply for their mortgages, while they won't have a credit difference, will it show up as an income discrepancy when they're applying for a mortgage? So people that have been off work for a month, that's almost 10% of a year. So that's almost 10% of their income. Now, will the banks be looking at that and saying, hey, look, you haven't been earning as much this year, therefore you're not going to qualify for as much mortgage? And I can tell you, representing buyers, that buyers will buy typically to the max that they're allowed to by the bank. So now if you've got people being qualifying for less, that's going to mean they're going to be able to buy less, which essentially is going to mean that they're going to pay less for properties. So you want to keep that in mind with regard to your intentions of selling your property. So it's either going to be a totally different buyer altogether, or you're going to have to reduce the price to still attract that same buyer that you've got going on. So that sort of rolls over into job losses, just like I was talking about with the fact that banks are going to be looking at it to see whether or not that they're how much money they've earned. They're also going to be looking at two other factors, and one of those is job sustainability. So there's the belief that there could be a second wave in the coronavirus, and if that's a legitimate concern, then what ends up happening is the bank has to look at it and say, well, you lost your job once. What's to say it won't happen again if this happens in the next flu season, which isn't too far away? So we're right now entering into May. You've got June, July, August, September, October, 6 months until we enter into the next flu season. Now, if this is as contagious as everybody believes that COVID is, you have to believe there's going to be another fairly substantial outbreak unless everybody's already had it and we all have the antibodies to deal with it. So the banks are going to look at it and go, there's the possibility that this person claimed for the CERP once, they're going to have to claim for it again. So that brings up a major problem. Now, talking about the CERP and the unemployment rate, the unemployment rate has reached 7.8%. That's massive. The only other time it reached as high as this, it went to 8.2, and I believe it was 2001, which would have been during the financial crisis. And a bunch of people lost their jobs there, and the job went up. Now, above that, the job participation rate has also dropped to levels that they've never seen, which we expected to be on a general decline because as the population gets older, there aren't as many people working. So as people stop working, the participation rate goes down. So we've got participation rate going down, unemployment going up, which means there's far less people working, which means they're earning less money, which means they're less able to purchase homes. So that is going to have a drag on the economy. So keeping that in mind, there was a study done out by, and I'm going to forget what it is, MNP Debt Index. And in the Financial Post, they reported that 49% of Canadians were concerned about insolvency. So there's 50% roughly of people in Canada are concerned that they might have to declare bankruptcy. That's a massive amount. So if that's the case, and if what we're seeing happening is this inability to earn money, then there has to be an increase in that insolvency rate. And in fact, I watched Steve Saretsky, who's a real estate and financial guy that I watch quite a bit. And he had interviewed a debt specialist, or an insolvency specialist actually, and they said typically 7% of their insolvency calls come from homeowners. And in the 2 weeks of COVID, first 2 weeks of COVID, that had gone up to 30% of their calls were coming from actual homeowners who were going to have to declare insolvency, or were looking at how to deal with that. So again, just some crazy, crazy numbers out there. And you want to keep all that in mind. Yes, I am looking at my sheet to figure out what my next topic. I might even have to get my glasses out because I didn't really write it well enough to see it. Anyways, this is what happens when you're old. This is why I don't wear my glasses, because I end up getting these funny circles in my glasses. So that's why I don't wear them when I'm speaking to you on video. So a couple of other things we're going to talk about is the personal mindset. So you have to remember that a lot of people are going to be looking at this and going, do we go back to work? Do we go back out and do what we do? As employers are going to be looking at going, do we actually employ the people back that we had before, or can we work with fewer than that? Because if they don't believe the production capacity is going to need to go up, they may hire less. And again, that's going to have an impact on the job market overall. Now, two other things that are going to play into this is that we are entering into a deflationary environment. Because what happens is all these people that have not been earning as much money as they're used to receiving, so the amount of disposable income is going down, they're also hesitant to go out because they don't want to spend as much money. Now, if there's not people spending money, then the supply is going to increase of everything that people buy, and the demand is going to decrease, and that is extremely deflationary, which means prices come down. Now, housing prices will be a latter thing to see that, but I think with the amount of volume decrease we're going to see in the next 6 to 18 months, I think that's something that we really truly need to be wary of and you need to think of. A final comment or component that we need to need to be aware of is OFSI, which is it's the financial services. It's the government body of the financial. That I cannot say that correct, can I? The Ontario Financial Securities Institution is, I think, what it stands for. Now, OFSI has let the office. That's what it is. Office of Financial Securities Institution. So basically, they govern what the banks do. So they have told the banks that they could reduce their capital buffer to 1% from a 2.5%. And what that means is the banks are allowed to loan out that extra 1.5% of capital out to people in the form of mortgages, bank loans. And they did that to try to stimulate the economy. That's $300 billion worth of money that the bank has been able to loan out. Now, we haven't got a final figure on that, but it does appear as though the bank is not actually loaning out that money because they're too afraid that people will not be able to pay it back. So although the OFSI has said that they can do that, they're not doing it. They're not lending the money out. So you need to be aware of that. So my personal belief is that, and again, I'm saying this is my personal belief because I don't want you to believe that this is the way you need to look at things. This is just the way that I see it. I do believe that if we get back to full capacity as an economy within the next 2 weeks, 3 weeks, this may have a small impact on the housing market. And what will probably happen is you'll see about a month of high volume, or a month to 2 months of high volume activity, where prices will be about the same as what we've experienced before in the past. But then they'll start to fall off a little bit. Then for the following 6 to 18 months, I think you're going to see a decline in prices that'll probably run down about 10 or 20% in price. That's my own personal belief. This is not statistical based on anything. Just as I'm looking at the numbers and you see an experience where the stock market falls 35%, then recovers about half of that back again, we're still seeing the valuation of everything being down substantially, and we're looking in the 20% region. There is a belief that the stock market will pull back again as people realize that these companies that were producing at the level they were producing at are no longer going to be producing at that level. As a result, your production again goes down. We're going to have some fairly substantial problems in the economy, and that'll also pull housing prices down. So that's kind of where I see it going. After that, it's a crystal ball for anybody. In fact, even what I'm saying right now is truly a crystal ball. But I do believe that we are going to be in a situation that the economy has never, ever seen before. From 2000 and, well, actually it's been the last 20 years, since 1982, sort of 2000, whatever. Since 1982, roughly 20 years ago, interest rates have been fairly consistently declining and house prices have been fairly consistently rising. Now we're at a point, like I said at the beginning of this, where the Bank of Canada is not going to be increasing interest rates. So typically, I think you're going to find that for the next few years, we're entering into a market where nobody has ever seen before. So this is going to be a completely different scenario. This is probably where you're going to see prices go down where they haven't gone down for a long time. And volume will go down quite dramatically as people try to assess where they are and what's going on. Now, I'll put a caveat there that I'm not selling my house. So I'm not worried about that. If I thought the market was going to drop like 30, 40, 50%, maybe I would actually sell my house, but I don't think at this time I would. However, if you are in a position that you need to sell, which this is addressed to, then I think you're going to find that we need to get on this and consider price reductions sooner than later. Consider reevaluating what the value of the property is, and then you need to decide whether or not you want to sell it or whether or not you want to hold on to it and perhaps rent it out, or what you want to do in that regard. I think that's the best information or advice that I can give. So I'll give you this information. I'm happy to speak with you, obviously, after you've had a time to sort of think about it and digest. And I'm also happy to answer any questions you might have about this. But it is fairly serious, and I do want my clients to be aware. I'm also going to ask that you please don't forward this on to anybody. I certainly don't want this to get in the hands of buyers. I'm doing this for our 6 listings that we either currently have or had coming on, and I just want them to be aware of the financial situation that we're all entering into in a state of the economy that nobody has ever seen before. So keeping that in mind, Squamish is a great place to live. Squamish always will be a great place to live. We will not be as impacted as Vancouver is impacted by something like this. However, we will still be impacted, and I hope not in too negative a way, but there will definitely be some hurt there in the short term. So that's the information for now. I encourage you to call me. I'll be following up with everybody next week just to talk about this and to ask if you have any questions and answer specific questions with regard to your housing situation. All right. Thanks very much. I'll look forward to talking to you next week. I don't mean to be a Debbie Downer right before the weekend, but I prefer to give you the information and then you can choose what you want to do with it. Thank you again. Have a wonderful weekend, you guys. Bye.